Stephanie Kelsey here, continuing with our bookkeeping basics. Now, we've done the chart of accounts, so I want to go through each one of the account types because under each account class, you're going to have several different accounts for different things. So first up, assets, the 1000 numbered from our chart of accounts. So assets, and I'm using my whiteboard again. Assets are anything of value, anything with current or future value for your business. So how do we break that down? Right off the top, of course, the bank. Cash is still king. Cash in the bank, it's a great thing. Next, we've got accounts receivable, or AR. Accounts receivable also gets very often referred to as AR. So this is the money that is owed to you from your customers. You have invoiced them. If people pay for your products right away, then you're not going to have an AR because you get your cash right away, which is smart. Keep doing that. Next is inventory. If you have an inventory of things that you sell and you track that, that is of value to your business. Next is any prepaid expenses. So think of this like if you've bought a subscription for a year, that is prepaid. If you pay for your website for the year or 2 years, that's prepaid and is considered an asset in your business until you realize that expense, which you can then have your bookkeeper or accountant do a journal entry on a monthly basis to reduce your prepaid expenses and just have that as an expense. But we're getting ahead of ourselves here. Also, investments. Any investments you've made, they're assets. Awesome. And then we've got fixed assets. Now, fixed assets are anything of great value. So expenses that cost you over generally $500, I don't know, maybe even $1,000 now with inflation. So these are things like land, if you have a building, if you are a renter and you've done leasehold improvements on your property, those are assets. Any equipment you use in the running of your business or any computers. These are all fixed assets. So, and you can depreciate those every year, and that's something your bookkeeper or accountant will do. So if you bought a piece of equipment that's $10,000, say, and you're depreciating it at 20% a year, then there's a contra account to fixed assets, which is accumulated depreciation or amortization. And so that would be, you've got your $10,000 a year, and then you're reducing that asset every year by 20% and writing that off as an expense. So that would be a $2,000 depreciation expense on that $10,000. And then after the first year, that $10,000 piece of equipment now has a value of $8,000. So yeah, fixed assets. There are other assets, but this is a good start. This is where most business owners are going to be at. So to start with, any bank, cash, anything you're owed, AR, inventory, yes. Anything you've paid for a long period of time is prepaid expenses. Those are assets. Investments, and then your fixed assets. I hope this is helpful.
Visit captureprofits.ca today.